Hi, this is Dee from Digreshko.com. This video will be about options implied volatility. Let's start by showing you the IV levels of two types of underlying or stock. The red line representing the activity of a more volatile stock, and the blue line representing the volatility of a less volatile stock. Both more or less stayed within the same volatility range over time. The IV range of an underlying can go up or down as time passes. This is a chart where the normal IV range increases over time. Moving on, we have some basic points of IV summed up for you. IV is used in pricing options. It's part of the time value component. It attempts to reflect the market's expected price move. The actual move that happens is a different story. IV of an option whose underlying has a steady increasing or decreasing price has a lower IV versus an option whose underlying is prone to outbreaks even if the percentage movement in a specific time frame is same for both of those stock or underlyings. Since 2008, implied volatility factor is greater in puts than in calls. Options are generally priced this way since prices take longer to go up than down. IV is imputed differently from strike to strike as well as between different option chains. This is what you call the volatility skew. You can interpret implied volatility as follows. 20% implied volatility per year means that the underlying has an expected move of positive or negative 20% from its current price base for the next 12 months. Normally, if you open an option chain, you will notice that the IV is skewed that the more out of the money a call option is, the less implied volatility it has. But the more out of the money a put option is, the more IV is factored in the options. This skew imputes the fact that the more prices go up, the faster they fall when they eventually do. This makes puts relatively more expensive than calls. Volatility tends to normalize over time. This behavior is known as the mean reversion effect. Every instrument has and maintains its own average volatility under normal market conditions. Not to forget, unexpected and/or material events increase implied volatility. Implied volatility usually crashes after a binary event, regardless of if the actual price base moves thereafter.